es una de las estrategias que tenemos aquí en nueva. El webinar nos va a acompañar Indira Díaz de Cementos Argos y nos va a acompañar también Andy Larkin, que es el vicepresidente de Relación con el Inversionista de Summit. Entonces, pues bienvenidos a esta conversación y esperemos que les guste. Es una gran noticia que tenemos hoy en el mercado de valores colombiano, particularmente en el mercado global colombiano, donde tenemos un nuevo emisor listado. Se trata de Summit Materials y todos muy contentos de poderlos tener acá. Con esta introducción, solo aclararles que el chat, el webinar lo vamos a desarrollar en inglés y tenemos obviamente la presencia de Andy, que nos va a contar un poco sobre el tema de las perspectivas de la compañía, va a introducir a todos ustedes a Summit y después vamos a tener una sesión de preguntas y respuestas en las cuales están súper ustedes bienvenidos a hacer las preguntas por el chat o cualquier medio que hayamos habilitado para que eso suceda. Y vamos a transmitirlas en directo y a Andy para que nos ayuden a responder. Y obviamente, si quieren hacerle preguntas en directo, pues bienvenidos también a la conversación. So let's turn and switch to English, Andy, and welcome here to this podcast and to this webinar, sorry. We are very happy to have you here and very happy to have Summit Materials in our global market. Welcome, and the floor is yours for talking about Summit a little bit.
Great. Thank you. Thank you all for having me here today. My game plan is to kind of ground you in the Summit story, talk about our business, where it is today, and a little bit more about where it's going. So I'm going to try, if I can here, to share these slides and walk you through it. Perfect. Here we go. So at the center of Summit is our mission, vision, and values. Our vision is to be the most socially responsible integrated construction materials solution provider, working with our partners to develop solutions for the future. We live our values at Summit, and central to that kind of value structure is safety. We have a zero harm mentality, our journey to zero. So here you see how we've reduced our recordable incident rate going back to 2010, where the peer average is about 1.7 recordable incidence rates, and we've been below that going back to about 2015. But that's not where we see things ending. We see ourselves getting down to 0% recordable incidence rates across our footprint. So safety is at the center of what we do at Summit. For background, our history, Summit was born in 2009 and grew up kind of through a classic private equity-backed roll-up story, making its first acquisition in 2009, and then moving through a cascade of deals from 2010 through 2013. And we entered into the cement line of business in 2015 with the purchase of the Davenport cement plant in Iowa. In 2016 through 2019, we continued that acquisition streak, deploying over $1 billion of capital. So from 2009 to 2019, it truly was a pure kind of roll-up story. In the interim, in 2015, we went public on the New York Stock Exchange. In 2020, Ann Noonan stepped in and realized, hey, we are a $2 billion plus company. And she wanted to really set the strategy to how to mature as an organization. And that's when we launched Elevate Summit in 2021. In 2024, we completed the transaction with Argos USA. I'll get into some of the deal merits as well as the synergy generation that is expected from Argos. But it essentially was an acceleration of the Elevate Summit strategy to be a more materials-led organization, and we'll see in a moment how we've done that. The Elevate strategy has four core strategic priorities. If I were to bucket them, market leadership and asset light comprise our portfolio optimization strategy. Market leadership to us means we need to be number one or number two in our chosen markets. If we're not number one or number two, or don't see a path to get there, then we execute what we call an asset light partnership, which is where we look to divest underperforming non-core assets to leaders in the marketplace and engage in long-term supply agreements. This allows us to participate in that local market growth while also protecting our number one or number two position in the aggregates or cement portion of the market. That third pillar is social responsibility. Here we look at sustainability through a value creation lens. So everything we do is backed by metrics and measured against how it can return value to our shareholders. So we don't do green just for green's sake. We do it when there's a business imperative to do it. Innovation solutions, to us, that means from the quarry to the customer. How can we improve the process flow, the production flow, to generate better outcomes for Summit Materials as well as for our customers? Embedded in this is a culture of excellence. How do we improve our commercial and operational capabilities such that we are the low cost provider of our product, and how do we better serve our marketplace? And then finally, our people are our greatest asset. We have roughly 7,500 employees in over 20 states in the United States and British Columbia. And how are we investing behind them in frontline leadership to make sure that the Summit we have today endures and grows stronger in the years ahead? Here's a snapshot of our portfolio. The primary takeaway for listeners is that we serve a diversified customer base. If I look at our revenue by end market, it's diversified across the public, non-residential, and residential end markets. When we say non-res, this to us is both light non-res in the form of office spaces and retail, but also in heavy non-res and manufacturing, green energy verticals, et cetera. Public infrastructure for us is repair and rebuild work primarily, and that's backed and supported by a significant investment via the Infrastructure and Jobs Act that was passed a few years back. Our state revenue, so we operate in over 20 states. You can see our split there. Our top 8 states comprise, let's say, about 75% of our overall sales, with Texas representing the largest proportion. Texas's DOT budget for next year, and there we have a large public exposure, and particularly in North Texas, is over $18 billion a year. So we are well positioned to benefit from the growth in the Texas market. And finally, by line of business, we are aiming to be a materials-led organization. So as a proportion of our EBITDA, we've generated over 75% of our EBITDA coming from materials. When we say materials, that means aggregates or cement. If I were to look back to when Elevate was launched in 2021, that number was closer to 63%. So we've made a mindful and purposeful choice to be in the upstream businesses, particularly aggregates and cement, with select positions in integrated markets like Salt Lake City. Our footprint, we would argue, is advantage. We know that population growth is the best long-term predictor of value creation in the marketplace, and so we want to be playing in those markets where people are gravitating to. And so the Summit footprint currently is in 9 of the 10 top 10 in-migration MSAs within the U.S. And so we think we are playing in the right markets for sustained growth. Here are Elevate Summit financial targets, and these are the things that guide our decision making. First is around net leverage, below 3 times. We've been below 3 times for a few years now, so this we have a very good handle on and good sense of. ROIC of greater than 10%. We look at that 10% as a floor. That is not a destination for us, but a floor for us. And we were knocking on the door of 10% ROIC a few years back. The Argos integration has moved our numbers back. I'll show you that in a minute, but we see a pathway to get to above 10% again on ROIC. And we have aspirations to be above 30% on adjusted EBITDA margins. This has turned out to be the most difficult of the three financial targets to hit. Clearly, inflation has set us back, but we have, as of Q3 2024, we have set a new high watermark for our adjusted EBITDA margin on a trailing 12-month basis since the launch of Elevate. And here is that updated scorecard, right? So you can see from working from top to bottom, leverage at 2.2 times is well below the 3 times target. Additionally, it's better than modeled when we completed the Argos transaction. So we are well ahead on leverage. ROIC, like I mentioned, had taken a step back. We were above 9%, above 10%, I believe, historically. But with the Argos transaction, we moved back to 8.9%. We noticed that there's a considerable amount of daylight between the legacy Summit cement assets and the legacy Argos cement assets. So that provides for us a clear glide path by closing that gap to restore that ROIC closer to and then above that 10%. And then adjusted EBITDA margin at 24.3%. Again, this is a high water mark for our business since the launch of Elevate Summit. So we are clearly executing against the strategy, and that in turn is driving considerable margin expansion. So the question is, why Summit Materials? Why do we have such a focus on being a materials-oriented company? Because that's where the richer margins are and more economically durable portion of the portfolio. And here we believe scale matters. In the U.S., we are the fourth largest U.S. cement producer and the largest U.S. domiciled cement producer. In aggregates, we are almost neck and neck with the fifth largest aggregates producer. We produce roughly 60 million tons of aggregates per year, and we see a pathway to get into that top 5. So here we are extremely focused on being a materials-oriented, materials-dominant organization. And this is really embedded in that strategy is fundamental industry characteristics that are very favorable. If I look at both aggregates and cement, we can agree that there's very limited substitutes, right? Cement is the most widely used building material in the world. And there's no replacement for the underlying aggregates that go into every building, heavy building construction material. Second, favorable supplier conditions, right? Aggregates is the ultimate local business. The product only ships roughly 50 miles. So therein lies a certain logistical moat to aggregates. On cement, there is a structurally short amount of domestic capacity for cement in the U.S. So on average, the U.S. produces, let's say, 90 million tons of cement per year and consumes well over 100 million tons. In peak consumption years, that U.S. consumption can get to 125, 130 million tons. So there's a clear gap between supply and demand in the U.S., and that's a favorable position for U.S. cement suppliers. In both aggregates and cement, there's high barriers to entry. Here, permitting on both aggregates and cement is very, very challenging. And then in the case of cement, there's very high capital costs to greenfield a new cement facility. So unlikely to see a large amount of domestic supply come on in the U.S. Between aggregates and cement, also a very low percentage of the end product, right? So you can spend $10 to $20 per ton of rock in aggregates, and for cement, you're about a single-digit percentage of new home foundation cost. So a very small portion of the overall product cost or project cost, excuse me. And finally, reputational factors, right? So particularly in cement, where sustainability is becoming more and more important, you want to be a valued member of that supply chain for your customers. And so those industry characteristics really underpin the thesis behind materials. And you can see here on the left, aggregates has shown a consistent growth in pricing going back 70 plus years. So it's an industry that has remarkable pricing ability that we believe is sustainable. Similarly on cement, going back 75 years on average, annual price increases have averaged about 6% and 71% of the years. So both aggregates and cement have proven to be a durable source of pricing growth for the industry. Here's a snapshot of our cement network. What I'd like you to see here is that our footprint really extends from the river market, so the Mississippi River, down to the southeast with the addition of the Argos assets, and so that we really become an all year round market by entering into Florida, Georgia, the Carolinas with the Argos assets. Here's our synergies that we're targeting with the Argos integration. So we're targeting 130 million synergies. It will come from a diverse stream of sources: cement, ready mix, scale synergies, which we include as procurement and SG&A, as well as commercial synergies and aggregates pull through. Our commitment on synergies has been to deliver at least 40 million in 2024 and at least 80 million over the first 24 months of integration. So by year end 2025, we should have a run rate synergy of around 80 million of the 130 million that we're targeting. Double clicking on where the primary source of the synergies are coming from, we have to look at the cement. The cement business will comprise about 60 to 70% of the overall synergy generation. And these are the metrics that we'll be tracking. First is around overall equipment effectiveness. This is our metric for uptime, right? So a world-class level is about 85%. Summit is currently around 84%, but that varies from plant to plant, right? So the Martinsburg plant, for example, at the time of the transaction had an OEE in the 50s, and we have a game plan in place to get that up to that world-class 85% level. The second core lever is alternative fuel replacement. We have a business within Summit that's called Green America Recycling. This is where we take in waste streams and convert them into alternative fuels that feed the cement kilns. By moving to an alternative energy, we reduce our reliance on fossil fuels, we reduce our carbon footprint, and we generate higher margins. Green America, that alternative fuel replacement, this is a legacy business, replaces about 40% of its kiln fuels with alternative fuels versus an industry at 14%. The Argos business has, let's say, call it the low teens of alternative fuel replacement. With the implementation of Green America Recycling at the 4 Argos cement plants, we anticipate bringing that alternative fuel rate above 40% over our integration timeline, which is 5 years. Finally, that last pillar is Portland limestone cement. Legacy Summit was the first in the U.S. to fully convert all of our production to Portland limestone cement, thereby reducing our. This is a variation on cement to include more limestone. It reduces the emissions and also is a margin kicker for us. You can see there we well outpace the industry in terms of Portland limestone cement. And here's just a snapshot in terms of where we expect the operational synergies to come from. You can see there that the largest proportion is around that OEE, right? That operational, that uptime, reducing the amount of critical failures. The second largest bucket is around alternative fuel replacement, the implementation of GAR across the Argos footprint. And then finally, the smallest piece of the 3 levers that I mentioned earlier was around Portland limestone cement. The timeline that we have for achieving these operational synergies is really a 5-year timeline, right? So in 2024, we conducted targeted capital improvements at the Argos facilities, things like replacing the bag house at Martinsburg. And we're currently underway with preliminary engineering around Green America Recycling implementation at the Roberta, Alabama plant set for 2025. In the course of going through the diligence and the beginning of these operational synergies, we've uncovered additional operational upsides. A lot of this has come from additional aggregates pull through. So tapping into the existing Summit network of aggregates to feed more into the ready mix proportion of the Argos business. Think in Georgia and the Carolinas, where we have an established aggregates footprint. How can we pull some of those aggregates through the downstream business to enhance our overall value model? Here are kind of 4 Elevate Summit near-term priorities. First is around integrating this Argos business, right? Making sure that we're doing all the right steps to make sure that we can bring the Argos business and the Summit business together under the one Summit operating model. Second, we have to invest behind aggregates growth. This for us is a core strategic initiative. We have ambitions to take aggregates adjusted cash gross profit margins up above 60%. In order for us to do that, we must get both the commercial excellence program to continue, as well as invest behind operational excellence. Third short-term priority is around generating our synergies, and finally is around optimizing the portfolio and the balance sheet. Here are our capital allocation priorities. First is managing our leverage at 2.2 times. We're well positioned on the balance sheet. Second is around investing behind growth, both organic growth in the form of CapEx and how do we unlock greater productivity through our network, and also inorganic investments in the form of aggregates-led bolt-ons in targeted markets. That's a primary use of our capital. And we're sitting on about $740 million worth of cash on the balance sheet. So we have built quite a war chest to go out and look for these aggregates led bolt-ons. And then finally, we do have roughly $150 million left on a repurchase authorization, but we would look at that opportunistically and within the context of what the M&A pipeline looks like. Here is our guidance for 2024. Coming out of our third quarter earnings, we adjusted our adjusted EBITDA guidance range from $970 to $1 billion, which would represent about 7% growth at its midpoint, which compares favorably to the peer group, which so we are growing the business at a faster clip than than many of our peers. We also provided preliminary 2025 commentary. Embedded in that is we believe price will be a durable growth lever on both the cement business as well as the aggregates business going into 2025. We are out with our January 1st pricing letters across the upstream businesses. We are trying to wrap our heads around what that traction is going to look like, but ultimately we anticipate a positive pricing environment going into 2025. On the demand side, our view is that it will be uneven and fluid. The public end market seems to be sustaining elevated public activity. So we think that should be another growth year for public going into 2025. Private end markets are a bit more uneven. And so we are kind of building our project pipeline for next year. And we'll have more to talk about in terms of demand outlook when we report Q4 in February. We do think we have unique self-help margin opportunities within the footprint. Obviously, the synergies that we talked about should continue into 2025. And also investments in operational excellence on aggregates should help to drive costs out of the business such that we have a really strong price-cost relationship in 2025. And finally, disciplined, accretive capital deployment. Again, we talked about those capital allocation priorities and investing behind growth. So those are our fundamental building blocks for 2025. We anticipate entering into what we call Horizon 2 in 2025. That's that 25 to 27% adjusted EBITDA margin range. So we anticipate landing above 24% adjusted EBITDA margins in 2024 with clear visibility to getting into that 25 to 27% range in 2025. So that was a fast move through the Summit story as well as our short term and 2025 commentary. So I'm happy to turn the call over to Q&A.
Super, thank you, Andy. I don't know, Indira, do you have any questions for Andy?
I have a lot of questions for Andy. So now that you were talking about 2025, we've been getting this question a lot, and we'd love to hear what you think about this. And it is, how do you feel like Trump's election is going to benefit or affect Summit's results for next year and for the years to come?
Yeah, first off, I think it's too early to say in terms of what the political ramifications are for our business. I will say that if we look at it through a demand lens, public investment in our infrastructure has historically been a bipartisan approach. So regardless of Democrat, Republican, blue versus red, we've seen a consensus that we need to invest behind our roads and bridges. And so I would anticipate that to persist. The IIJA funding sunsets in 2025. And so we're looking at fiscal 25. So we're looking at fiscal 26 as restoring what that next leg of IIJA looks like. That's not to say that the dollars run out, right? We have still yet to deploy about 50% of IIJA funding has yet to be deployed. So we are well positioned from a public perspective today, but we do have to start shifting our focus to what that new IIJA reauthorization would look like. In terms of a continued investment in manufacturing. So, I think we came out of COVID understanding that we had more vulnerabilities in our domestic supply chains. And so there's been a public as well as a private push to make our domestic supply chains more durable. We don't look at that as episodic. We look at that as a secular trend that we would anticipate persisting through both administrations. So the one area that could potentially see pieces move around the chessboard is around the IRA funding, where the investment in green energy or the investment in EVs could be, you could see some of that shift around. But again, it's too early to say. So we're pretty confident that regardless of the political environment, there's strong tailwinds for our industry over the next few years.
Perfect. We have here a question from the chat from Marianne Goni. She wants to know about the public infrastructure sector and your perspective on the kind of effects that have in Summit.
Yeah. So when we look at our major public markets, we see leading indicators remaining really strong, right? So we look at state level DOT budgets. And so across our 8 states for fiscal 25, they're up roughly 4% year on year. So these are large and growing DOT budgets. The second thing we look at is lettings within our footprint. And so these are the highway awards that come out monthly. And within our top 8 states, we are outpacing the national average by about seven points. And then we look at our backlogs. So our backlogs are up year over year going in, and the large proportion of our backlogs are comprised of public related work. So for us, we don't see any slowdown in terms of public activity. And it's important to look at some of our major markets, right? So we have a large asphalt business in North Texas. Here is, we do about 40% of our overall asphalt in North Texas. Here they're seeing their DOT budgets up about 10% going into 2025. So for us, we don't have any, we've heard some caution around public activity, but for us, when we look at it, it remains strong and elevated going into next year.
Thank you, Andy. And of course, the other question is about the private sector.
Mm-hmm.
What are your views on that?
Yeah.
And what are the indicators that you monitor in Summit?
Yeah. So if I were to break down the private sector into non-res and residential, we have we're kind of in, we're pretty neutral on that going into 2025. We look at some of our larger residential exposures, and we see varying trends, right? So Houston, Phoenix, and Salt Lake City are our three major residential markets. Houston is more normal, right? So there you have bigger builders, there you have ease of permitting, there you have in-migration trends. So we see a very normal environment in Houston. And so that's poised for kind of continued strength going into next year. Phoenix, we would say, is normalizing. It's getting to that point where affordability could potentially come back within a more normalized area, but it's still relatively sluggish. And finally, on Salt Lake City, that's the one that has the most amount of headwinds. It's coming off peak levels from COVID era migration, but it also has much smaller builders that work in Salt Lake City, and so really that affordability gap is the most prominent in Salt Lake. And so what we've tried to do is pivot some of our activity into the public. But we know over the long run, we're bullish on Salt Lake City. We know that as soon as rates come down, we'll see that demand come off the sidelines. So this, we understand, is kind of part of the industry. And so we're very comfortable with our exposures on residential and the direction that they're headed. On non-res, right? So this is where we're seeing differing trends, right? So on the light non-res side, think your retail, think your hospitality, think your offices. This is more sluggish, right? This follows 18 to 24 months of residential build out. And so with residential being more or less in a holding pattern, we don't see that light non-res coming back. And so that's going to be a more muted outlook for us going into 2025. The heavy non-res, think your large-scale manufacturing, your green energy projects, those types of things. Those we see sustained activity on those going into next year. Those can always be a little bit lumpy depending on that project pipeline. So we have to compile our project list for 2025, and we'll have more to talk about in February when we're out with our 4Q earnings. But essentially, there's pockets of green shoots. It looks like non-res will be less bad going into 2025. But again, we'll put more meat on the bone when we talk to markets in February.
Thank you, Andy. I don't know if Indira, if you have another question.
So we have another question more into it's like a short-term look, and it is, how is the company recovering from recent climatic issues like the hurricane that we had recently in Florida? And you mentioned also in your call that you had some more weather days this year than last year in the third quarter. So do you foresee that there's going to be any additional affectation arising from this in the fourth quarter of this year, or how is it looking so far?
So we tried to put some detail around the weather impact on Q4 in the slide deck that we presented a few weeks back, and we characterize it as 12 to 18 million worth of EBITDA headwinds from Q3 related events. And we cautioned another $5 million due to Hurricane Milton hitting in Q4. Those we would consider gross numbers, meaning if we get an extended construction season or get a dry stretch of weather, we can make up some of that ground that was lost due to the hurricane. So we wouldn't endorse just penciling in that upside for next year as of yet, because our teams are out there running as fast as they can to try to make up some of those days that we lost earlier this year due to weather. And thankfully in October we had relatively dry conditions across our footprint, and our teams were out there moving materials pretty well. If I had to say in terms of the major weather events that we've incurred, Hurricane Debbie was the most impactful. That was the one that hovered over the Carolinas and dumped a good amount of precipitation on the Harleyville quarry that feeds that cement plant. Our teams moved quickly to bring in portable crushers and pumps to pump out the water. Inevitably, those it's very difficult to make up for some of those days because of how short that supply is in that part of the world. But our teams worked very aggressively to try to restore that as quickly as they can, and we did our best to mitigate that impact. And the fact that we only had to kind of adjust our EBITDA outlook for 2024 by $5 million is a testament to the number of kind of self-help margin opportunities that we have in our business, which I think is a unique differentiator for us at Summit, right? Whether it's synergies, whether it's OpEx, whether it's portfolio optimization, we have a strong contingency plan when we're faced with these weather impacts.
Thank you, Andy. One question for you: if I am a Colombian investor and I want to know information and the latest news about Summit, what is the best channel to be informed?
Yeah, listen, I think signing up for our email alerts on our IR website is the best way to get our public press releases fed directly to you in real time. We have, for example, last month we had the ribbon cutting or maybe it was 2 months ago, we had the ribbon cutting of our Green American Recycling expansion at our Davenport facility. That's the first pre-commercialization installation of a pyrolyzer technology that will take our alternative fuels up to above 50% in that plant. And so that's a really great way to stay in touch with what Summit Materials is doing. We are also out on the road a lot. So if you ever find yourself in major U.S. markets, whether that's New York, Boston, Chicago, we keep a pretty aggressive marketing and investor outreach. And so look for us at conferences, NDRs. And I typically have our CEO or our CFO in tow with me.
Super. Do you have any list of analysts that cover the stock?
We do. Yeah, we have about 16 coverage analysts. I believe they are up on our IR website. I'd have to double check that, but I believe they are. And so, yeah, the sell side keeps me quite busy. But yeah, we've got a good amount of coverage.
That's
so
the
perfect.
job,
And
right?
the good news from the Colombian market is we are going to have some more analysts covering the company from Colombia. So that's a good news for you to share.
Great. No, that's it's primarily U.S. domiciled business, but international investors clearly have demonstrated an interest in the U.S. market, right? Whether it's the CRH relisting in the U.S., Wholesome looking like they'll come to the U.S. market. I think there's a lot to a lot to like about U.S. market dynamics and participating in that growth. And so we're excited to be there.
Super. Indira.
Just, I mean, taking, now that you mentioned that, what would you tell an investor of why it is interesting to invest in the buildings material industry of the United States? Why is it appealing for an investor right now?
Listen, I think I kind of outlined the pricing power on both aggregates and cement in my prepared remarks. If you look back over 75 years on aggregates, it has averaged about 3 to 5% pricing growth per year. That's a durable, sustainable piece of and it's not getting any easier to permit these greenfields. And so we are sitting on, hundreds of years of reserves that are only kind of growing in value. And the ability to grow via M&A is a real opportunity. We look at the states in which we play, and they are largely unconsolidated markets, right? So there are about 1,100 opportunities within the states in which we already play to go after quarries in that regard. So the pricing element on aggregates is really strong. I think it's really misunderstood how strong the pricing environment is for cement. As I mentioned, over the last 70 years, 70% of the time, the annual increase in price is around 6%, and when it does go down, in that other 30%, it's only gone down about 2%. So that's the pricing picture. We feel very comfortable about where that's going. And then if you think about the demand side, right, we've talked a lot about the public investments that are necessary across the U.S., but on the private side, it's pretty well understood how underbuilt we are from a residential perspective in the U.S. So depending on the estimates you look at, it's 3 to 7 million of single family houses that were underbuilt in the U.S. So we need a sustained investment in single family construction in this country that should over time start to bring that supply demand back into balance. But that's going to be a strong tailwind for the industry in the next few years. And then we would argue that the onshoring of manufacturing is a secular trend for the industry. And so that's going to be, if I think about some of the investments in things like chips, those are multi-year investments, right? That's not a one and done type of investment. So, and what we really love about those is that you get the initial bump from the investment in manufacturing, but then you get higher employment. That higher employment brings on the need for more housing in that area. And then that housing brings on a need for more of that light non-res. So we look at these large projects, these large manufacturing projects, as the kind of gift that keeps on giving, right, for us. So that's, to me, a really compelling reason to be in the industry in general, right? Pricing going to be sustainably strong. Demand, while we're in this kind of fluid period right now, the long-term trend is up and to the right for us. So that's really compelling. And why to be in Summit? I would say because of our unique ability to drive margin expansion, right? That's the synergies, that's the operational excellence on aggregates, and that's the continued portfolio optimization across our footprint, and a balance sheet that can go out and make accretive bolt-on acquisitions in our space. So that's what gets me really excited about Summit.
Perfect. I have a question maybe for Indira and yourself, Andy, of course. We have a lot of investors used to invest in Cementos Argos, for example, and take exposure to that name. So here comes Summit listed in the exchange. And how about the arbitrage opportunities that you have envisaged in the next months, Indira and Andy?
So yes, definitely. I feel like this Summit transaction, for us, it's been probably the most interesting of the last decade, and it's brought a significant amount of value for our shareholders. And if you look at, I mean, both stocks from January until November, you see an interesting correlation between both stocks. And by having Summit quoting in the MGC, it opens a great opportunity for local investors to arbitrage between these two species. And that's, I would say, the main reason why we've been promoting and trying to get Summit to quote locally, because we feel like it's a very good opportunity. And in our case, we feel like it could bring additional liquidity for our stock, which is absolutely necessary in our market and for our investors.
Andy, can you talk a little bit about volumes of traded of the stock in the U.S.?
Yeah, so we do a little over 1 million shares a day in the U.S. and our trading activity has been I would say very healthy, right? So it
That's
trades.
how much in dollars, Andy, right now, just for people to have an idea.
Yeah, we're at about $50 a share, $47, $48 a share, and a little over 1 million. I'm trying to pull up the 60-day average, but 1 million has always been a pretty reliable kind of mile marker for us. And it's probably moved a little bit more over the last 30 to 60 days because of earnings, because of news flow and things like that. But, my understanding is the name trades pretty well and pretty liquid and doesn't have much in terms of concern from our market makers. So for us, it's the fact that we can have the listing where it does help the arbitrage position.
Perfect. You're talking about market making, and we have launched the stock here at the MGC quite a few moments ago, and there was a market making participation here in Colombia. Indeed, can you talk about this a little bit?
Yeah, so we do have a market maker in Colombia, which is Credit Corp, and they have committed to provide liquidity also for Summit's share in the MGC, which is going to facilitate the arbitrage locally between the two species. Going back a bit to what Andy was mentioning on Summit's liquidity, so I was making my number. So it means that your ADTV is something close to probably $50 million, which is a dream for a local issuer here in Colombia. So I'm drooling here. We have a long way to go to get there, but definitely it's great to have an issuer with such liquidity quoting in our local exchange.
Perfect. I don't know, Indira, you have any other question?
Just one final question, and it is, how do you see Summit's strategy going forward? So from here to probably 5 years, do you see ourselves investing outside of the US? How do you see? I mean, how do you feel like it's going to progress in the midterm?
Listen, I think the strategy is pretty well defined in terms of our interest in being a materials-led organization. So you can see us continuing to build out our materials portions of our portfolio, invest to grow aggregates in targeted markets. We've made recent acquisitions in Arizona and North Florida. We look at those as platforms that have more opportunities for additional bolt-ons. We do see the more we get under the hood of the Argos transaction, with the more opportunities we see for aggregates pull through, and trying to recognize some of the benefits of the scale that we have from those markets. So to me, it's more about the less about any pivots and more about the execution of the strategy as articulated, right? So how do we kind of maximize our current strategy and execute against it? And so for us, So for us, that's really the focus, right? We're less than a year into the transaction, right? So we're clearly in execution mode now, and I think we've got a lot to be proud of in what's otherwise been a very challenging operating environment, given weather, given some of the demand issues that the U.S. has kind of dealt with, and we're still able to grow EBITDA dollars and EBITDA margins in a very healthy way for 2024, with more of a glide path set up for 25. So to me, it's less about strategic pivots and more about strategic execution, which we have a really good track record on.
Perfect.
Thank you.
So Andy, thank you. Thanks a lot for being here in this webinar. We are very happy and excited here at the Stock Exchange to have you guys here. Thank you, Indira, again for being with us also. And it's a huge opportunity for Colombian investors to invest in this kind of company. Just to share with you, Andy, the stock is already trading in the Colombian Stock Exchange. Also, you have a new investors from this geography in your company. So thank you again for being here. Congratulations.
Congratulations to you guys. Thank you.
Thank you.
Bye bye. Muchas gracias a todos y hasta la próxima en otro webinar de Mercado Global Colombiano.